Shopify, ticker SHOP, reported their Q3 earnings on the 12th of November 2024, and upon that news, the company rose by more than 20%. Together, we will review these financial numbers and highlight why the stock price is soaring. We will also have a look at Shopify's financial data and calculate its intrinsic value to see if investing in the stock right now is a good idea. Over the past year, they are up by almost 60%, which means that they have beaten the S&P 500 and returned almost twice as much. But if we have a look at the 5-year chart, we can see the high volatility of Shopify. So if you were to invest from the second half of 2020 to about the end of 2022, you would currently be sitting at quite a big loss. But if you were to invest into the S&P 500 in this time frame, you would still be sitting at a positive return. Now, even though they are up by 60% over the past year, it doesn't mean that they are fairly valued. So if we jump to our stock valuation spreadsheets, we can see that their PE ratio is currently sitting at 103, which means that investors are willing to pay $103 for every dollar of Shopify's earnings. And to put that into perspective, the average stock PE ratio is at 22.5. So it is quite clear that investors are currently tremendously overpaying for the company. But let's have a look at their Q3 2024 report. The revenue growth accelerated to 26% and free cash flow margin expanded to 19%. Shopify achieved 26% revenue growth and 19% free cash flow margin this quarter, marking their 6th consecutive quarter of greater than 25% revenue growth excluding logistics. Now, last year's third quarter gross merchandise value grew from $56.2 billion to $69.7 billion. And the gross merchandise value is how much money flows through Shopify through all their users. So it is the most reliable metric to measure their growth. Their monthly recurring revenue grew from $137 million to $175 million. Their revenue grew from $1.7 billion to $2.2 billion. Gross profit grew from $900 million, crossing the $1 billion mark, to $1.1 billion. Operating income grew from $122 million to $283 million, and the free cash flow grew from $276 million to $421 million. So we can see nothing but growth. They also increased their year-over-year revenue growth rate from 25% to 26%, and their free cash flow margin increased from 16% to 19%. So again, there is nothing but growth in this report. But if we jump back to our stock valuation spreadsheets, which by the way you can always download at the link in the description, as it is a great tool for beginner investors to start understanding all the important metrics one needs to value a stock properly. Now getting back, we know that the PE ratio is sitting very high and investors are currently overpaying for Shopify tremendously. But if we jump to the second pillar, we can also see the price to free cash flow sitting at 154, which is even higher than the PE ratio. Now regarding their growth, we know that year over year they are doing very well, and it seems like over the past 5 years they are also doing very well with an average revenue growth of 41.38%. We can see the very nice growth from 2019 of 1.6 billion to 2023 7 billion in revenue. Now regarding their net income, we can see that that is all over the place over the past 5 years. And if we jump to the fifth pillar, the free cash flow over the past 5 years, we can see that that has been increasing as well from 13.86 million in 2019 to 905 million in 2023. Their profit margin is even more impressive than their free cash flow margin, currently sitting at about 51%, and over the past 5 years, on average sitting at 52%. Now in pillar number 7, we have a look at the decreasing shares outstanding. And normally, we like a company to be buying back the shares outstanding. But Shopify is a slightly different story. Over the past 5 years, they have actually been selling out more shares at a rate of 1.5%. And the reason why we like this is as we know the PE ratio of the company is very high. So investors are currently overpaying for the company. So it wouldn't make sense for them not to sell out more shares at these high values and buy them back later when they are not so overvalued. Now we will skip pillar number 8 as Shopify currently doesn't pay out any dividends, and we will arrive straight to pillar number 9, which is the long-term liabilities over the 5-year free cash flow to be sitting below 5. And this is arguably the most important metrics out of all the 9 metrics, as it tells us whether a company generates enough free cash flow to cover all their long-term liabilities so that they don't get into trouble paying off their debt. And we can see that this ratio for Shopify is sitting at only 0.71, which is a very nice ratio and means that they can pay off all their long-term liabilities in about 4 years. Currently, we can see they are sitting at about 1.1 billion in long-term liabilities. That is quite low for a company with a market cap of 140 billion. But before figuring out their intrinsic value, let's have a quick look at tip ranks and see what the analysts say. Currently, they have a 21.37% downside with an average price target of $85.31, which is lower than the current trading price of $108.49. So currently Shopify seems to be growing at a decent rate. They have low debt and don't waste their free cash flow on paying out dividends. But they are also extremely overpriced compared to their earnings. So let's see what's their intrinsic value. So first we will jump to the Grams formula revised, where normally we would take the 5-year earnings per share, but for Shopify this is sitting at negative $0.04, which would give us a negative intrinsic value. So what we will do is have a look at the current earnings per share of Shopify, which is sitting at exactly 1.05. So we'll jump back to the Grams formula and plug in 1.05. And we can see that this will give us an intrinsic value of $47.87, which is still 127% lower than the current trading price. Now moving to the next valuation model, the discounted cash flow model, we will take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at 491%. Now the analysts project growth rate of 22%, and as we saw today, the growth rate is sitting at about 19%, so I will calculate a positive growth rate of 20%, and using that, I will calculate the future free cash flow. And then by plugging in the discount rate, which I plugged in at 8.1%, I will calculate the present value of that future free cash flow. I will then sum all of that up, add any cash and cash equivalents, subtract total debt, and get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $30.20, extremely lower than the current trading price. But now let's have Shopify go through one more valuation model, which is the multiples valuation. And here we compare the company to its competitors, so VRSN and GoDaddy. So we will take these companies' current stock prices and divide by their earnings per share to get their PE ratios. Notice here that their PE ratios are sitting much lower than Shopify's PE ratio. So when we average out these two PE ratios and multiply by the current earnings per share of Shopify, we get a very low intrinsic value of $18.59. Again, very much lower than the current trading price. And finally, we will skip the dividend discount model as Shopify doesn't pay out any dividends and arrive to the ultimate valuation, where we will average out the 3 valuation models we did and get an intrinsic value of $32.22, which is 70% lower than the current trading price. Shopify seems to be doing quite well. They have growing revenue, they have growing free cash flow, and they have very low debt. And with today's digitalization, they are a business of the future, but they are currently just too overpriced. And so we would not recommend adding this company to your portfolio as of now. And with that, we hope that you enjoyed the video. Make sure to leave a like and subscribe as it really helps us out. And let us know down in the comments which company you'd like us to evaluate next.